Manager. Okay, we are live. Good morning, good day, good afternoon. Depends on what time you are watching us in your part of the world. And my name is Clara Lyons-DeVaughn. I am the broker owner of Lyonsview Realty. Our team provides residential, commercial for small businesses and nonprofits and property management services. We also excited to announce coming is Lyonsview Academy, and we'll be providing real estate licensing, continuing education, credit counseling. We do distressed home owner solutions, and we're getting into lifestyle, health, wealth, and wellness education. So, Lyonsview Realty launched Financial Fridays to really help you stay current on those trends that affect your bottom line. Our goal is to assist you and provide you with resources, tools, information, and tips to assist you in making the best financial decisions. Our commitment is to maximize your wealth building power now and in the future. So I'm glad that you joined us today. Welcome, welcome, welcome. Feel free to like, share this video with your friends and family. This is a really important topic today, and our guests are here as a resource to you. So feel free to ask questions. If you have any, just drop them in the comment section down below. And I'm really, really, really excited about today's guest because it is Home Ownership Month. And what is more phenomenal during Home Ownership Month than credit? So I want to introduce Miss Almitra Tankersly. Did I pronounce your name?
No one usually does, but it's Tankersly. It was close enough.
Tankersly. Okay. And this gal talks credit. She's the founder of Credit Fitness Inc. And I met Miss Almitra. God, it's been about a year now,
It
maybe
might be 2 years. It might be going on 2 years.
2 years now. Yeah.
Yeah. Time
She,
flies when you're having fun.
indeed, indeed. She came and spoke to our board at the Southern New Jersey National Association of Real Estate Brokers about not only personal credit, but also business credit for our professionals, for our real estate professionals. So she has in her bag, there are lots of tools, resources, and tips. So you want to really pay attention, get a pencil and pad, take notes. Without further ado, I want to introduce Miss Almitra. And if you could just tell our audience a little bit about yourself.
Yes, thank you, Clara. Hello, everyone. Happy Friday. This is my norm. I know, right? Where did the week go? It was just Friday, like a few seconds ago. Right. So here we are. My name is Almitra Tankersly, and of course, this gal talks credit. I am a credit specialist over here in the Philadelphia, Pennsylvania region, just across the bridge from Miss Clara. And we specialize really on helping our clients get access to creative financing and lending opportunities that they normally wouldn't be able to via using their EIN number. And so because so many of us are business owners, entrepreneurs, serialpreneurs, we use our personal credit to do mostly everything we need to start the business and as well as sustain it. The problem is we get into trouble because the credit scoring model on the personal side was never designed to carry your business. And if we really understand the whole concept of business and personal, you'll understand that personal is just a form of you saying, hey, I have an opportunity to get on some kind of payment terms, and basically you're going to show everyone that you can manage that. The problem is the more you use the card or the more you go into debt on credit cards, and we're really speaking of credit cards here, you start to tell the whole world that you're living off of credit. So henceforth, you'll lose tons of points, and usually tons of points can be the difference of you leaving one credit category into a lower category. And so therefore, business credit is why it's so relevant for you to establish, because that rule of thumb of carrying balances goes out the door. So that means that you can actually carry a high balance or use the entire credit limit and not be punished. Okay, so that's the difference. And so we stress for our clients to understand the differences, as well as know how to be the best consumers they can be on the personal side so they can push the button when they need to.
So how did you get involved with credit counseling and credit solutions?
Yeah, well, I was my own client. This was not my career choice. I started out as a student in college at community college. I got my graduate associate's degree from there after leaving Temple, bombing out, and restored myself in community college. And I'm the oldest of six children. And so
Wow.
my father worked for SEPTA forever. And here I had the opportunity to join this awesome program at Drexel University as a physician assistant. And I was going to kind of work my way up to becoming a doctor in neonatal care, pediatrics. And I did all the grades. I was a 3.8. And I was just super excited that I was, graduating with this high honors situation. And the moment they ran my name for the grant money that they said I was getting, all was declined because I was still being claimed by my father as a dependent student. So I was disqualified. And of course, I was super hurt because I did all the work. I actually had a job, so I was paying bills. I didn't understand concept of independent and dependent. And so, long story short, my father was the last resort to see if I can get into this program, which at the time was new to Drexel, and I think it was about $62,000 a year. So it was a 2-year program, and so they're like, "Oh, well, don't worry, your father will, be able to probably qualify for the SSL loan." Of course, I was like, "Sure, he can. He worked for SEPTA forever, and he's always got us on trips, so we'll be fine." Well, he was declined. And so therefore my dreams were declined. So that was 2 declines in my life, the grant money and then this wonderful loan that was declined. So I was devastated. And I think I sat in a financial aid office sitting there just crying. And she's like, just take your time, and just to let you know too, that it was one more other opportunity for me to get money, but my dad made $1 too much. And she actually turned the graph around and said, "I'm so sorry." So of course that was 3 strikes and you're out. And I said, what is this thing called credit? Because I couldn't even take out the loan myself. And I think really it had a lot to do with me taking on tons of credit cards when I got in Temple. They lined their tables up against the welcome aisle, and they say, "Hey, come on over here and fill out an application. You get a bag of M&Ms." And of course, you're hungry, so they're like, "Yeah, give me a bag of M&Ms," and I'm getting a credit card. But I really messed myself up when I was in my tenure at Temple. So by the time it was, time to do this at community and launch over to Drexel, it didn't work for me. It didn't work for my dad. And I was devastated. I was just like, why is this 3 small digit number ruining my life right now? So I was determined to find out what this thing was all about. And lo and behold, I find out that you can change the stupid thing, the credit profile, enhance it. And so I was like, no way, this is like magical. So, of course, in the very beginning, no one really shared how this whole thing worked. I think a lot of people were probably still figuring it out because it was, mostly done by mortgage brokers. But I had to really dig in. So here I am 22 years later in regards to helping my own clients and helping them to understand the mistakes they need to avoid, because I made all the mistakes. I spent over 6 figures in between losing property, cars are included in that, homes, money, cash, hard cash, earned dollars, and then education. Education was super expensive. It was not cheap at all. But I do continue my education yearly, annually. And so, yeah, here I am.
So what, for like the basic, like what would be the short answer? Like what is credit?
Right. So credit is a term saying that you are able to repay someone on a term. Okay. And that you're going to adhere to the terms. That's what credit is. So if you think about a family member, you've given your family members credit in some way or form, and they already have like a score in your mind or on your books. So if they came to you, and let's just say, that one family member that always says, "Can I hold $50? I'll give it to you on Friday," and you never see them again until that actual holiday comes, and they're hiding from you. So you already given them a credit score, basically, like, I would never lend to them again, right? But of course, the dollars are larger in some cases. Some of us as family members have co-signed for people to get cars. Most of the cases, it's cars. And the car goes late, or even worse, it's repoed. So that information now shows up on that personal credit report that you have. And most people, that's where everyone gets that ugly feeling like I would never co-sign for anyone ever again. And so that's kind of like the same situation. Credit is what you're willing to give someone based on a term of agreement of repayment. And if they should, do great. And in most cases, credit usually earns interest for the lender. So yeah, I mean, it's a good setup if people adhere to the terms. That would probably be the best way to say that.
Okay, so basically it's I owe you, you're willing to give me money, you're willing to extend money to me, and I'm saying I'm agreeing to pay it back. So
Correct.
you've extended
on the term.
On the term. On the term. Right. That's the important thing. On the term.
Yes, on the term.
Establish these credit scores, and who generates the scores, and what kinds of things are credit scores used for?
Yeah. So, well, everything today. Actually, it goes way into employment. I do have a lot of clients that contact me from the military, and I, being a military wife, my husband's a vet Marine, they would get in trouble for not repaying. They would get in trouble by the COs. Now, of course, that's a lot of laws that are being violated right there, but they're the government. They do what they want. But it can actually, keep you from getting security clearances in the military. You can be demoted.
Banks, yeah.
Say that again.
People who work for banks too have to keep their credit.
Yes, I actually worked for a bank, and credit was definitely important, because if you have issues with collections or high balances, you might just get an idea to figure out a way to get money from the bank and pay your stuff off. So yeah, that would be important to make sure that you have a good credit score. Also, health and life insurance, car insurance also is determined by your credit scores. If you kind of think of someone that might have a low credit score and a car is involved, you might be that person based on their studies that slams on the brakes and gets hit from the rear, and now you have a case. So they look at you as high risk. So yeah, those credit scores can actually determine even insurances. And then of course, cars and the homes and your credit cards, as well as installment loans. Those things are also, possible for them to base the scores on. But most importantly for the banks is how much they can charge you. So you'll have people that make six figures, and I always go for six figures because I think a lot of people misconstrue the fact that if I make only 30 or 40,000, there's no way I can do what these 100,000aires are doing. And that's not the case at all. In fact, I deal with $1 million revenue earners, and really their scores are still in the 400 or 500s. And so it's add a zero, add a comma, it's all the same. Okay. And it's unfortunate, but you have to remember the banks are willing to give you money based on what they think they know you're going to, be able to pay. Because if you have the income, they're like, well, we'll give it to you, and it's your job to figure out how to pay it back, because it's not their job. But in most cases, a lot of thousandaires, a lot of millionaire earners, I'm speaking of earners, because having $1 million in the bank cash whole card, that's different than just being $1 million earner, because you have expenses you got to pay out of that. You got, bills to pay. So sometimes you can have $1 million and I say $1 million in revenue. Yeah. But when you look at your bottom line and what you bring home, sometimes people don't even get a chance to pay themselves, and they're zero. They're just trying to make it, but they're willing to pay all their employees, pay all their vendors and merchants and bills. So that's why I have to say that, because I think some people just wish, if I only had 50,000 extra or 100,000 extra. It's not the case. If you can learn how to do it on a $20,000 to $30,000 income, Indeed. Oh my gosh, you will be amazing. You'll be everyone's superhero and role model, because you understand the basics. So credit is something that can free you up. In most cases, for right now, I have a ton of clients who were furloughed, who were laid off, and some not even getting their jobs back. And so because they were able to work with us prior to COVID, I mean, who thought of COVID? I don't think anyone saw COVID coming. I mean, powers that be.
Obama saw him coming.
Yeah, I was going to say the powers that be saw it, but us laymen, we didn't see that. So we're operating as normal. And so those that were able to work with us they were able to carry over on themselves. In fact, some people have, applied for deferments and stuff like that for their bills. A majority of my clients didn't. Okay, so that's the power of what credit can do, because it can give you that extra cushion just in case. And that's what credit really should be used for. It's the just in case, not because I can. Right. I can spend the money because I can. It's not that. It's really supposed to be used in a strategic manner to be able to then say, okay, I'm furloughed, I'm off. So, and then to even go in deeper, I think a lot of people don't talk about insurance policies. So I have a client who introduced me to this person who is amazing. She is a beast, and she sells whole life insurance policies along with other different bank products in that arena. But she took some of my clients and helped them buy these awesome policies that are like virtual real estate. And I'm like, you can do that? Oh my gosh. So, we have tons of people that have actually bought their policies, and whether or not the market is up or down, their stuff is still good. So it's just an amazing thing to be able to have credit to work for you. And I think this is also, speaking on insurance, for those that didn't save for their 401ks or their Roth accounts, to be able to utilize that as an opportunity to catch up. Because some people are like, oh my God, it's going to have how many years I'm going to have to wait? But if you really look at what's out there available, if you have a cushion or at least a little room to breathe, you can do some things. It really does allow you to do some things and even save your income. If you're, bringing in revenue and income, you can save those dollars. The rule of thumb is, if you look at the bigger corporations, I think a lot of us miss the fact that if we can at least understand what the bigger corporations are doing, like Walmart. Walmart has over 531 lines of credit. So that means when they walk into, I shop at Walmart for those that are still open. A lot of them are torn down and they're not even open right now from the riots. But just imagine that when you walk into a Walmart with those pretty fluorescent lighting, right? Everything on the shelf is bought or purchased with a credit line that they have. So when you go and pick up the item, whether it be paper towels, toiletries, whatever, and you walk up and pay for it, you've paid for their credit line. Yes. Now they make profit and keep it.
Right. And I appreciate the relationship that you're making between all of the financial things that are in the toolkit. So credit is one thing in the toolkit. Insurance, and we've had people come on and talk about insurance on Financial Fridays, is another piece of the toolkit. That Roth, your savings is another part of the toolkit. We were talking about debt and being debt free and putting savings away on last Friday. So all of these things, they work together. And so people talk a little bit about the score and the range, and because people don't understand, you say 400 from an 800, like what's the range?
So the range, according to FICO, according to FICO, which, by the way, I always love to ask, what does FICO mean? But FICO is just a company.
Put it in the comment section.
Yeah, right. I was getting ready to say it. Put it in the comment section. We'll reward you for that. So the range, according to FICO system, is a 300 and it goes up as high as 850. Now, some people are looking at credit scores that might give them a 990 and or a 200 as far as the low. But you have to, it's almost like knowing a counterfeit versus an authentic. And I think as women, I really still can't tell the difference sometimes between some of these authentic bags. Unless I go to the site and then get a friend. I have a friend. She actually went to school.
When they look at that score, though, that score is pretty concrete.
Well, no, not exactly. No, not exactly. Because I've actually had two clients actually this week, and she calls me. She's like, Almitra, I looked at my Karma and I looked at the other monitor that you gave me, and the score was a 550. Then I go directly to the actual creditors with TransUnion, Experian and Equifax, and they're all 100 points higher. And I said, and I said, good job, you're paying. She says, well, no, I'm upset because I need to know which is my score. Why would they do that? Why? I went to the source. Why would they do that? So good question. Why would they do that? right? So the point is that you have to know the difference between an authentic and real score, as well as knowing what the fake score. And so the scores that you can even obtain directly from the bureaus are fake scores. And I say fake because there are tons of formulas.
What's the range? Right, what's the range though? So
Yes,
that's
it's
another.
300.
That's a
It's
whole nother
300 to
show.
850. Yeah, so the
Yeah,
range is 300 to 850. But
what's considered good or bad or
yes,
if
so
it was an authentic, let's assume it's an authentic score.
Okay, so let's talk about authentic score, but we have to make sure people know that if they're looking at their credit card scores and Karma, they're not the real score, even though it might say it's 300 to 850 because they have the same range. So to really know what your true scores are, I'll just put it out there and say, go to myfico.com. They'll give you 27 scores and you'll know all the fake scores and the real scores. Okay. Now, as far as a good range, I would say, well, first, anything 650 and below is considered not great. Okay. 651 and above, you're doing a little something. Okay. So if we were to kind of really get like to the number 651 to about a 719, 720, you're kind of doing something. Now, if you heard me say 719, that's because those numbers, even though you might say, I'm in the 700 club, but you are still possibly going to get batched with a 698. So whatever a 698 interest rate is, more than likely that 719 will get it as well, which is like, ugh, right? So in regards to a higher or the top tier lines of credit, 721 and above is what is considered. And 721 is like the bare minimum. Like you just got your toe in the door. So having a 721 and above is really your top tier of lending. And then there's also relative to who's actually giving you the funding. Sometimes car dealers will give you top tier lending with just a 700. Whereas if you're dealing with mortgages, they may want to see a 740, 767 as that highest tier before they issue you, a decent rate. Does that make sense?
Yeah, that does. And one of the things I think people don't get it, that how blessed we are because, at 640, you can actually purchase that's a good thing that someone is willing to extend a credit for a 30-year fixed mortgage, that's a long-term commitment based on a 640 credit score. So, and now with the pandemic, that's going up. We think 660 that they're around 680, or like you said, the rates that they're being charged, people are being charged are higher if the score is the same 640. So there's opportunities associated with having a score that's higher and trying to get your score as high as possible, but it doesn't preclude you, from being able to do certain things. You're just going to pay more for it. That's the bottom line of it.
Right, exactly.
Go back and renegotiate that later.
Right.
And get that score up, but that's the thing. So what makes a score go up and down? Like what are the categories and what are the buckets?
Yes. So the buckets are, if everyone can remember these numbers, it's 35, 30, 15, 10, 10. Okay, that's the magic formula for understanding the bucket. So one of the buckets is your payment history. Okay, that payment history is how you pay. Do you pay when you feel like it? Or do you pay on time? And do you pay before time? They even have a scorecard if you pay before time. Some people don't realize that, but it's actually embedded in the coding of the report. You won't see it on a general report, but mostly you'll see it on, like if they were to go directly to the bureaus and get that real 50-page report, all those codes are usually on there, and it's also usually on mortgage payment or mortgage reports, the tri-merge reports. So those scores are based on the payment history. The other one is how much debt do you carry with credit cards? I know some people are like, oh, I have a mortgage or a car loan, and they're thinking those heavy weighted items are going to really like be the main thing. They really don't do too much as far as the heartbeat of the credit report. It's the credit cards. So if you're missing credit cards or you have cards that are zero or canceled out or you closed them, there's no heartbeat there. So you're not going to get the highest scores in comparison to someone who does have a car loan or a mortgage and credit cards. Even with a high balance, they're still going to have a better heartbeat than you. So those carrying balance will also be part of the bucket. The other one is the history. Are you someone that just woke up today and said, I'm going to do, something with a credit card or get a car loan, versus someone who has been in, came out of college 20 years ago, got a little credit card, kept the credit card, maybe student loans. Student loans is like the new mortgage today, right?
Right.
Student loans actually count for, the history. So the history is also important. And then your time of your inquiries. Inquiries is something I think so many people bypass. They're like, oh, I'll just apply for everything. If this one didn't get approved, I'll go to the next one. And it just keep doing it over and over. Having so many inquiries will also factor in the score. In fact, when it comes to business financing, the banks don't want to see you having more than 4 to 6 inquiries in a 24-month period. That's a long time, right? So that can actually be effective. And then the last part is your different parts of credit or different types of credit. Meaning, are you that person who just has all credit cards or all student loans? I know a lot of people just have all student loans, one credit card, right? So the bucket really should, in regards to types of credit, should be credit cards, car loans, or an installment loan. Mortgages fall into that place, as well as, other, meaning store cards. Okay. Mm-hmm. So that would actually create that entire bucket within a bucket, because you have to have different types. So those are the 5. I mean, it's really not that deep, but you can see how it can be a game where it can hurt you if you have one out of balance. Does that make sense? So again, that formula is 35, 30, 15, 10, and 10.
So the 35 is for
your carrying balances.
Okay. And the 30
is
for
the how you pay.
And the 15?
The 15 is for, oh Lord, I need my coffee. 15 is
Sorry.
History. No, your history. And then your 10 and 10 is your increase. And then the other one is 10 for your types of credit.
Gotcha.
Okay.
Gotcha.
Yeah, I need coffee. I was drinking water, but I need coffee. Wake up.
So if they wanted to improve their score, which of those areas should they focus on? Is there a first area, or is there a strategy on what's the best way to improve?
Yeah, that's a great question. So what we do is we create assessments for each client that we speak to, because everybody's report is different, like the fingerprints on our hands and toes, right? So in regards to saying what should be first, is really looking at the report, because even though you and I both may have similar things on our report, I could be out of whack on my balances and no derogatories are on my report. You, on the other hand, could actually have tons of derogatories, very low balances, and what would we need to start with first would be 2 different answers. Okay, right. So in this situation, what I just said, it could be that I just need to pay down my balances and my scores jump up 100 points in 45 days. Versus you could have low balances, but you got a ton of new collections or whatever, and it might take a month or 2 for that to even, be addressed, just because their collections, or maybe your person is just paying late every single month with that creditor. Okay. So it does take an actual eyeball to look at it, assess it, and then come up with a strategy. And that's what we're doing. We actually do that every single day, all the time. So if I said I had 10 reports in front of me, almost every report is super different, but almost so close.
Yeah. So what are some of the biggest mistakes? You just said one, which is assuming that there's a one size fits all, like what for me is going to work for you. What are some of the other mistakes that people make when they're trying to, improve?
Yeah, most people, I think, run to paying collections off. They're like, oh, I want to pay this off. Let me get rid of it. Even if it's less than $100, that's still a mistake that could actually make you lose up to 150 points, just thinking that it was helping you. So collections are usually the main thing I see people make mistakes of. The second mistake is taking their balances to zeros. Zeros means a 0 for the bank, which gives them a disgruntled feeling, and sometimes they'll just shut it off. In fact, I had a few people that came to us and said, they closed my Barclays card. I had it for 20 years. Why would they shut it off? I've never paid them late. And it's because if you don't use the card for so much time, usually like within usually 6 to 18 month span, they'll shut you off because they feel like someone else can use that.
No
So that
heartbeat.
can drop, no heartbeat. And then, of course, that
Yes.
shut off card can make you lose up to 200 points, depending how old that card is. So those are the main two. Now, of course, I go into it in depth with my classes, which, by the way, corny little plug, we start
Yeah.
classes for personal credit on Monday. But we really, it's because it's too much to talk about in just a couple of minutes because there's so many different areas, but we want to make sure you're equipped and have the etiquette of understanding how you're supposed to address it. So if you're that person that's like, I'm ready to change, I got 6 more months before 2021, which by the way, I'm looking forward to 2021, but 2020 was really good. This made us realize who we really are, right? Like you found out who
Yes.
you were.
Yes.
You
That is
found out who
so
you were this year. But
yeah.
yeah, I mean, we talk about this stuff in the classes so that way everyone's situation, yes, is different, but all the information that they gather will help them to not only understand the current situation they have, but how to be prepared for future situations, if that makes sense.
Mm-hmm, mm-hmm. And on the inquiries, like one of the things that I get all the time on the home buyer side is people say, no, don't run my credit. I don't want, so
Mm-hmm.
many inquiries, but the lender has to run their credit in order to, move forward
Right,
the process. So
right. Yeah,
how
so
do
what
you
I do, I actually have a
Mhm.
lot of relationships with mortgage brokers and mortgage bankers just because of that whole, oh, don't do that. So what we do is we give them an in-between platform, which we provide for our clients as well. It's a link for them to be able to pull their credit before they're interested in pulling with a mortgage broker or a banker. So
That's
that
great.
way the broker,
Yeah.
yeah, so that way it really kind of helps the broker to save their deal as well because it allows them to see, okay, I have their report and I can see off the bat. I mean, if you have the experience long enough in your industry, you should be able to look at the report and say, it doesn't even make sense to pull this for the product that they're looking for because this has to be handled. Okay.
Mhm.
So once those things are addressed, let's say it's high balances, for instance, right? That's usually an easy fix if the person has the funds to take care of it. But let's just say they're high balances. Instead of pulling a hard inquiry on that person, knowing that the rate is probably going to be stupid and it's not going to be what they want, you have a dead file on your desk now. You
Mhm.
could actually reverse that as the broker and say, or the banker and say, okay, listen, get this taken care of. And
Right.
I'll relay this information to Almitra if you're working with her. And that way you'll have accountability to make sure that they can watch it. And the moment that's done, then we'll pull a hard on our file because we have to create the file on our side by pulling your credit. So that's how I was able to establish a lot of my relationships with brokers because we did just what I just said. And they're closing and they're like, Almitra, I love you. I closed 8 deals this week. And I'm like, you're amazing too. You're their superhero. So, I mean, like I said, my motto is the party doesn't start until you get funding, whether it's you getting the mortgage guarantee or someone's getting funding for their business. Like that's when the party starts. And that's why no one really feels like the credit score, it's like, what's a good credit score? Well, a good credit score for somebody could be, hey, I got a 640. I got a good credit score. That's good for them, right? Because they got approved. And so, it really depends on what's good to you. If, like you said, if you feel like you want to get into a house and you're at a 5, because I know someone that just told me, hey, you got any clients in the 500 scores? I'll take them. And I'm like, what you mean? They're doing that again? That sounded like back in 2004 and 3. I said,
Yeah,
what is
580
going
was
on?
the lowest I heard. So 500.
Yeah, yes. She said, I'll go. She said, it's in the 500. She said, but I would rather be like in the 550, 580 range. That's the lowest, but they go as low as 500. And in my head, I'm saying, what do those interest rates look like? Right.
Right,
But the point
right.
is that for a person that may have never had the opportunity to buy a house, that's a good credit score for them. They're like, I don't care. I got in and we'll talk about it later. So if a person is able to do that, we can talk about it later. Let's talk about improving the score. And depending on whether or not, that company doesn't have any penalties on prepayments or during refinancing, because, they got clever too. They're like, you can't refi until whatever that term is, right? But at least
Yeah.
that gives the time for the client to make
To work on it.
improvements.
Yeah, to
Right,
work.
right, right.
Yeah.
Exactly.
Yeah. This has been really good. And I know it's not enough time to cover
I
everything.
know.
I learned a few things. Like, so one, you got to have a heartbeat. You know, you have to
Yes.
have some activity on whatever credit you've got. And
Yes.
two, it needs to be positive activity. Like, you want your heartbeat to
Yes.
be strong. You know, you want to pay on
Yes.
time. You know, you want to pay before time if you can, which I didn't
Yes.
realize that gives you a better heartbeat. We'll say it that
Uh-huh.
way.
Uh-huh.
You want to keep from your overall credit, you want to keep that the amount of credit lower. So we didn't talk
Mm-hmm.
about that. So what's the percentage of
Yeah, so it's
total
arguable
debt?
amongst the industry. Yep, it's arguable against the industry, and it's really
Mhm.
relative to what you're doing. Okay, so if you're buying a house, I always say try to get the balances as low as possible, but not zero. If
Yeah.
you're looking to get credit cards, you need to have about 25 to 29% of the total limit given to you on credit cards. Again, we're only talking about credit cards. Stay away from paying off loans. Okay. Some people say, I just paid off my car loan. I'm super excited. And the credit scores drop. That's closing an account. So try to pace yourself when it comes to doing payoffs. And that's mortgages included. Because I know some people say, I'm going to pay my mortgage off in 5 years. Just be super careful. Make sure you're planning with someone, whether and not I won't only say financial planners because I teach financial planners. But the point is that if you're going to strategically pay things off that has a heavy weight, you got to remember it's weight. So if we had a even scale and you put one heavier weight on here and one heavier weight on here, and then you decide I'm gonna just pay this off. So you're releasing the weight. This is going
Yeah.
to drop down. It's going to
Yeah.
drop down, and this is hot. So it's
Yeah.
relative to physics. Like people don't understand if we didn't pay attention to science in class and mathematics, man, we are jacked up. So there's math involved, there's physics involved. So if you
Yeah.
are not strong in those areas, pick someone that is. So that
Right.
way, when you're saying I'm paying things off, this is my goal. Now you're able to at least have some form of something to replace what you're getting ready to remove.
Yeah.
Okay,
And give
so
people an understanding of why their score dropped or why their score didn't
yes,
go up, even though they paid something off.
yes,
So if they paid
yes.
off, say, the mortgage has a heavier weight than, say, a credit
Mm-hmm.
card. So
Yes,
you want to
yes,
keep that heartbeat or that part of the
yes,
blood strong to
yes.
balance off everything.
Exactly. Because even
Got
with refinances, that's considered payoff too. So like I have
Mhm.
people that are calling saying, hey, I want to do a refinance. The rates are great. And I'll say, is the rate more important than you dropping your score 200 points? And it might take you a year or two to get back to where you're at. And they're like, what you mean? They get real upset, real quiet. What do you
Yeah.
mean? And I'm like, because you're closing the account. A new bank is going to take over that refi, or it could be the same bank, but the account that was 15 years old or 10 years old
Mhm.
is going to be cut off. So
Right.
that does change the score. So you have to figure out with your professional who's working with you, is this worth me doing the refinance for a few extra hundreds to
Mhm.
save? Or do I just continue to pay, go get something else that can replace what I'm getting ready to do, if it's even
Mhm.
worth it? Okay.
Yeah,
Because they
if
allow
you
the
need that credit
products.
score to do something that it depends on what you're trying to do with that credit score. Yeah,
Exactly. Exactly.
got it. So
Yep.
there's a whole strategy, it sounds like, and a whole
Yes.
plan, and working with someone like you know, that girl's talks credit. Tell people how they can contact you and talk about this upcoming class that you've got that's coming up so people
Yes.
can dive deeper into how they can adjust and improve
Sure.
their credit score, you know, and
Yep.
actually work on their financial planning because it's not just the credit, right? It's not
Right.
just the score. You know, it's what
Right.
you need to do with it, you know, how you want
Yeah.
to use it, whether it's personal or business. And one of the things about Almitra, she does both. She does the business side and she also does the personal side, and they're all tied together. So, yeah, talk.
Yes. Yeah, so the classes is definitely my passion. So that's why I'm actually putting out there. You probably can tell I love to teach. And so they start on Monday, June the 15th at 7 p.m. virtually. And
Okay.
so we'll be able to really give you a 12-week span of time with myself. I'll be teaching, and they're live. Most people have these wonderful recorded classes. I've done recorded, but it ain't nothing like live. I just like the interaction. I love hearing the new, examples of how we can explain credit better to individuals that are attending. But we're starting on Monday. They can actually go to our promo page at enforcedaccuracy.com. That's enforced with an ED at the end.
How do you spell it?
Accuracy.
Put it in the
Yep.
chat.
Yep. It's ENFORCED. The word accuracy.
ACCURACY.
.com.
Okay.
And then they'll be able to see both classes for business and personal. One of my favorites for personal is Homeway and Power Score. So Homeway is just for people that are like, I just want to know how to get my foot in this house, or do a refi, or maybe they're trying to just get a car and a house, or all the above, right? And then Power Score are for those that are like, yeah, I'm trying to do the house too. I got this car I hate. I need to get rid of the payment. It's not the car I want to drive. But I have a business too, Almitra, and I need to understand this business credit stuff. They would be able to do Power Score, and we'll be able to, kind of prepare them and put their profiles together to be able to do something within the next 90 days after dealing with that class. So, or simultaneously, I've seen a lot of them like, if I had only met you last year. And I'm like, it's okay. Timing is everything. So, but yeah, those classes start on Monday.
Right.
And so then, let me give you my business site. Huh?
Yes. Yeah. So it's like your number is there, but
yeah. So my business site is creditfitness.co. Creditfitness.co.
Okay.
And then, of course, if they go to that page, they would be able to find all of our socials on the bottom, the social medias that we're on. And the only one that's not on there is where I'm at on Facebook and Instagram. That's my unplugged version of me, where they'll usually see me with this background. You see that? Yeah. Hello, credit scores. Yeah, so we more so just kind of have that intimate conversation in between. I'll do a live every now and then. That handle for Instagram and IG or Facebook is TGTC. That's the acronym for This Gal Talks Credit _ unplugged. So they can jump on there and catch me doing whatever I do. But it's more so focused about, credit situations.
Wow. Well, I just want to thank you.
Thank you.
Yes. Catch Almitra's class. It starts on Monday. So if you want to dive deep into, really improving your score, your credit score, definitely take her class. It's been a wealth of information. I hope that.
Thank you.
Yes, please feel free to like, share, and subscribe to this video.
Yes, like and share, y'all. That's for free. I'll be telling people, look, stop acting like y'all the bestest on the planet. Share this information, because somebody's suffering silently, and you're sitting there with like, I heard this gal over here, and you didn't say nothing. So that's blood on your hands. But I hope that, people do get over the whole concept of credit. It's not always about having bad credit. Even if you have bad credit, you don't have to tell the whole world. In fact, this class will allow someone to attend anonymously, so they can actually find out how they can attend anonymously, being as though we do deal with a lot of high profile clients that are like, I don't want nobody to know I'm talking to you. That's fine. We still have an opportunity for you to still learn.
Yeah, that's important. And credit is like the heartbeat.
It is. In fact, if you see my logo, you probably understand why we have the apple and the heartbeat. So the apple is based on you getting information, being taught to keep your heartbeat right, and it's a healthy healthy EKG, not just a little blip. No, it's a healthy EKG.
Yes, boom, boom, boom,
yes,
boom,
yes,
boom. Yes. So get your credit score. Reach out to Miss Almitra, and thank you again for
you are
being with us
welcome
today. Thank you for those of you who are watching. If you have any questions that you didn't put down in the chat, put them down there. We will get back to you on your questions. Any questions that you have, reach out to Miss Almitra directly. And just thank you for watching today. Financial Fridays is really here to provide you with the resources, the information, the tips that impact your bottom line. This is really important stuff. And we hope that you receive something of value today. So I just, as always, want to send love, light, and prayers out to anyone who has lost a loved one, during this pandemic. For people who have people in hospitals that they can't go and see them and visit with them. For those of you who are experiencing the physical distance in some kind of way, and also to our essential employees, and for all of us who are getting back out to work, just be safe,
Yeah.
practice physical distancing, practicing your mask, just keep it safe, our healthcare providers, our people in transportation, food service, police, fire, protection, and our leadership, all y'all who've been holding it down for us over the past several couple of months. Yes, love you, love you, love you. Encourage everyone, just take care of yourself, take care of your family, stay safe, take care of your credit during this time. My name is Clara Lyons-DeVaughn, and Financial Friday streams every Friday, 9:30 a.m. on both Facebook and YouTube. So you can join us again next Friday at 9:30 a.m., or you can always watch the replay. And 10, oh, thank you, Miss Vanetta. Until then, keep living your best life. Love you. Thank you, Miss Almitra. God
You're
bless.
welcome, Clara.